base your base case on 50% inflation in the next 5 years and pray and hope that it doesn't happen. Well, they are at it again. They are about to print another $1 trillion. Now, the number $1 trillion blows our mind, right? But it's in the news all the time. Didn't they just pass a bill for $1.5 trillion just recently? We're throwing around these numbers, $1 trillion, every couple months now, and we're burning through cash like crazy. Now, this is going to surprise some of you, and for others of you, not. Look at this. The U.S. Treasury said that they plan to borrow another $932 billion in the first quarter, almost $1 trillion in the first quarter. Remember that they're burning through $1 trillion already every 9 months. This trillion is on top of all that. Now, you got to think about this is because interest rates are hurting you with your mortgages, right? And you're like, well, the people who are renting, they don't have to worry about the interest rate that's going up. Okay, but it worries a person that is mortgaged a lot more. Well, what happens if you have a 20 unit or a 50 unit apartment building? Now it's hurting you even worse. But what if you are the largest debtor on the planet, the United States government? How much interest do you think they're paying? It's coming to the point where all of the money that they take in taxes is only going to pay for the minimum down payment on the property. And it is not just the United States. We're talking about Japan already passed that a long time ago. The United States are there. Canada is going to be there. Euro is going to be there. All the Western markets are going to be there. Now, let's dig into this article a little bit more. So you can get this on fortune.com. Here are some of the takeaways of it, though. Remember, they said this is much higher than they had projected last October, but that it is lower than expected income tax receipts and higher spending. Does that sound like a general person right now that's in this recession that we're in right now and no one wants to call it what it is? Because everyone's saying, well, I lost my job and I'm in trouble. I need to make a couple more bucks somehow. I don't know how I'm going to do it, but they're saying I'm going to make less money and I have to pay out more because inflation is higher. That's the exact same story as millions of people fighting with inflation. And now the government is fighting that as well. And their solution is borrow more money. Same as us, we're seeing as a population, we're turning to our credit cards now to try to fight this. Let's continue here. It says even just the threat that the US government might fail to meet its obligations may cause severe harm to the economy by eroding household and business confidence. Remember, because the US dollar is only based on fiat or faith. It's not backed by anything. It's just a worthless piece of paper that we somehow believe is worth something. So if we cannot undermine the confidence, we don't want to inject volatility into financial markets and raising the cost of capital, among other negative impacts. You guys, this is the most serious thing when we're talking about, oh, the home markets could collapse, the prices of homes go down. Listen, they already have in many cities, they're down 30, 40, 50%. But if you want to wipe out the treasuries, if you do that and you wipe out the treasuries and there's no confidence left in buying US debt, that's it. Game over. The whole system's over. The whole show. We're talking the whole euro dollar market that the entire world runs on. You wipe out the treasury, it's it. The life as you know would be over. But my point is they are planning to borrow $1 trillion. So what does that look like? Now, you guys know I'm in Canada. So I just wanted to pull up, if you go to tradingeconomics.com, you can look at what the chart looks like, completely like a hockey stick. I mean, it goes straight up, especially after 2020. Okay, well, let's look at the United States. Oh my goodness, it does the exact same thing. They're identical. And if you go look at the euro and Australia, it's all the same. But if you notice here, just the very tip, it just tips off a tiny little bit. That tiny little bit is the slowdown that you've seen now, that they're slowly going to unwind their balance sheets or sell some of the assets that they have. So, I mean, right now, the US government has 25% of all the mortgage-backed securities. They're going to start selling those. And so that is that little dip that you see there. But remember that this is a hockey stick. Now, let's look at this again. Canada, United States, Canada, United States. It looks very, very similar. Now, let's even look at more similar. If you overlay the two graphs from the United States money supply and the home prices. Let's go back and forth. Homes, money supply, homes, money supply. What you're going to notice is they almost track the exact same line. And therein lies the difference, you guys, because when we're talking about inflation, there could be several things that are coming into play right now. When there's inflation, imagine you have the same amount of homes, same amount of jobs. Just imagine that. And a million people come in from, let's call it Ukraine, from a war, and they come live in that country. You don't have as many homes. So the demand for homes goes up, prices go up, but that is a push inflation. Now that inflation is because more demand came in. Now, how and when, we can't tell people where to go anymore. My grandfather, when he came to Canada, was told you have to go to this town. You have to live there for 10 years. So things are different now. So we can never always push that. But what you can confidently know is the government's going to need more and more cash, period, forever. And they're going to have to keep printing. As you saw, they're now going to print another trillion because they're like, whoops, interest rates are higher than we thought. And so houses track that inflation. And remember, we live in a centrally planned economy where the interest rates guide everything. Let's jump back to this chart. Again, remember, money supply and home prices follow very similar. But if you go to US debt clock and check that out, it doesn't matter what country you're in. If you're in Canada, United States, Australia, Europe, just choose your country. They all are in a similar trajectory. We can see US debt. And the debt is $31 trillion, soon to be 32.5 right now, right? As they're going to raise it up. But this is not the problem. If you think that that's where it's going to stop, you are dreaming. Go to the bottom right-hand corner of the U.S. national debt, and you're going to see something called U.S. unfunded liabilities, and it's sitting at $181 trillion. Hang on a second. 181 trillion would basically be like aliens coming down from outer space and purchasing Earth. Okay, that's how much money that is. And that is how much is indebted right now, that they have unfunded liabilities. But what is that? People went to war and fought in a war, and they were promised to have health care when they were done with the war, or you've paid into a pension your whole life and you expect payments or medical treatments or something, a payment later. Imagine you have a baby, and that baby, you've paid for their food and diapers for the first day, but how are you going to pay for it for the next 18 years? I don't know. I have to figure that out later. So that 181 million is the, I got to figure it out later because I know that those bills are coming, and they have no way of paying for that except printing. This is what we run into all the time, is people are telling us that, oh my goodness, we've never been here before. This is what I hear. We've never been here before. That number has never been here before. My question to you is that correct, that we have never been here before? This is what I want you to understand, and I think that this will drive it home the best. Please look at this chart right here and notice what the chart says. So go to Trading Economics and write in debt to GDP. So you don't understand how much debt that is because we don't know those numbers. Imagine you had $100,000 debt and you made $100,000 a year. That's 1 to 1. Okay. And that would be the 100 number that you would see. You owe 100% of your income in debt. And today we're at 130% debt. And that's not including the trillion that they plan to spend. I have to jump in there and tell you guys that this is the caveat. 130% is like no man's land. This is no coming back from it. In the past 200 years, there's been 56 countries that crossed that line of that much debt. And once they crossed 130% debt to GDP, 55 of the 56 have collapsed and they disappeared. Who is that mysterious one who didn't? It's Japan. And Japan has gone so far over the line, they're just in the midst of it. So it's not like you have even a 1 in 56 chance of getting out. It's happening whether you like it or not. So how did the United States get out of this thing the last time? This is what we want to know. Take a look at that chart again. When was the last time we hit that level of debt? Was at the end of the Second World War. End of the Second World War, right in the back of the chart. How did the amount of debt collapse, shrink way, 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 way down? That is my question to you. How did we do that? How did we pull off that magic trick? Inflation. Inflation makes the debt cheaper for the government. So here is your base case. You have to prepare yourself for 10% inflation for the next 5 years. This is how they got out of the last time they were in that pickle, but that was during a Second World War. So we now have binged on a lot of debt, and they're going to have to dig their way out of this hole. I know it sounds funny, right? They're going to have to dig it out, and it's going to be 10% for 5 years. That's my base case. So why don't you prepare for the worst and then hope for the best? All these people that are telling you that, oh, guys, we've never been here before. Yes, we have. Debt to GDP. Oh, it's like 2008. But 2008, we hardly had any debt. We could add, and they only had to add like 600 billion or something to bail everybody out. We're talking about trillions like it's Fruit Loops, just throwing that name out there. This situation that we're in is nothing like the 70s. It's nothing like 2000 or 2008. It's a completely different scenario. Please dig into 1945 to 1950. Dig into that era, because that is the most like where we are today. Base your base case on 50% inflation in the next 5 years and pray and hope that it doesn't happen. But if you are prepared, you won't be scared. Anyway, you guys, thanks very much for following me. I really, really appreciate it. Please consider liking this and sharing it around if it's giving you any value. Hopefully, I earned your subscription. Have a great day. We'll talk to you soon. Thanks so much for sticking around. If you like that video, you might like this one and maybe something like that.